Support and resistance has always been considered a beginner method of trading, but did you know that there is a new way of approaching support and resistance that is way better than the conventional method? This new method involves using the previous session's highs and lows as the support and resistance levels. The beauty of this strategy is that you don't even need to manually identify these previous session's highs and lows, which would obviously be time consuming. Instead, we're going to employ a single TradingView indicator and have it do the task for you and me. Stay tuned because it's gonna be a wild ride. Now, the indicator that we're gonna be using for this strategy is called previous highs and lows. To add it to your chart, you wanna go to TradingView, which is the trading platform that I'm gonna be using. If you need to sign up, the link for that is gonna be in the video description. Next, you wanna load any trading security that you like in any time frame. For me, I'm gonna be using the 15-minute time frame of GBP-JPY. After that, you wanna click on indicators and then type in previous highs and lows. And it's gonna be this one by Lux Algo. The Previous Highs and Lows Indicator by Lux Algo is a tool designed to highlight key levels of previous high and low prices within user-defined intervals. These levels are important in technical analysis because they often serve as support and resistance levels where the price of an asset may react or reverse. This indicator is really simple. It's made up of only few components. We have these horizontal lines which represent the previous highs and lows. Red lines represent the previous highs. Green lines represent the previous lows. Now, you may be thinking, but what periods were used to generate these highs and lows? Well, by default, this indicator is going to be generating these highs and lows based on the daily time frame. These red lines represent the highs of the previous 4 days, and these green lines at the bottom represent the lows of the previous 4 days. Why only 4 days? Well, it's because by default, this indicator allows you to show the highs and lows of the past 4 days, but that can be changed in the settings. Now, these highs and lows are going to be represented by numbers to indicate how far back they go. For example, this one is labeled 0, which means it's the highest price reached for the current day. And then 1 represents yesterday and 2 is for the day before yesterday. Same thing for the previous lows. 0 is for the current day, 1 is for yesterday, and 2 is for the day before yesterday. Simple. Now, looking at the settings of this indicator, we can see that we have the first option, which is Show Last. This is basically going to be the number of how far back you want to draw the highs and lows. So if you wanted to go back 4 days, you put here 4. For me, I'm going to change this to 2 days. Now, you have to remember that this is only termed as days because we've chosen the frequency to be the 1-day time frame. But if we click right here, you can see that we can also have the frequency of 1 hour, which means this is going to show the highs and lows of the last 2 hours. And then, if it's on a weekly frequency, this is going to be showing the highs and lows of the last 2 weeks. For this video, I'm going to stick with the daily time frame because it's more common. And then we have the area's width, which is going to be the thickness of the areas of support and resistance plotted by this indicator. I'm also going to filter based on position. What this is basically going to do is it's going to filter out these highs and lows to only have the previous highs above the current price and only the previous lows under the current price. So instead of having both the previous highs and lows above the current price, you're only going to get the previous highs. Same thing down here. Instead of having both the previous lows and previous highs under the price, it's only going to display the previous lows under the price. And then here, we can change the colors of the previous highs as well as the previous lows. After you've made your changes, click OK. Now, in order to use this indicator to trade, we have to add one extra indicator to the chart that we can use for trend identification. That indicator is called 7EMA_5MA, this one by Storewise. Double-click on it so we can change some settings. On the Inputs tab, you want to change EMA1 length to 8, and then 13, 21, and 34. On the Style tab, we want to disable every single moving average except for the first 4 options. After that, click OK. Now, the way we're going to be using this indicator to identify the trend is really simple. Whenever these 4 EMAs are aligned like this, with the price consistently trading under all the EMAs, that would indicate a bearish trend. And of course, the opposite of this is this, an arrangement of these 4 EMAs that looks like this, with the price consistently trading above the EMAs, that would indicate a bullish trend. Now, how would we use these two indicators to take long and short positions? Well, it's really simple. Now, assuming you wake up on a fine, beautiful day, ready to tackle the market, you look at your chart and you see that your indicator has labeled this dotted line as the current day's highest achieved price, and this is the current day's lowest achieved price. Now, to extend these to the right, I'm gonna put a white horizontal line right here, and same thing for the low price. I'm gonna put a horizontal line right here. Now, we know that this is the high of the day and this is the low of the day. You go about your day and then a few hours later, the price breaks and closes above the current day's high. What do? You get ready to enter your position because looking at the EMAs, they're also indicating that this market is bullish. But you don't just enter immediately after the price breaks and closes above the current day's high. Instead, you wait for the price to come back and retest the level. So let the market play out, and as you can see, here we had a retest. A retest is basically the price coming back and touching this white line only with a wick. Now, if the wick candle happens to be a green candle like this, we will immediately enter our position because a green candle is a bullish candle, which indicates that the price may continue going upwards. But if this candle were to be a bearish or a red candle, well, in that case, we would wait and anticipate that the next candle is a green candle, and then we will enter the trade on the close of the green or bullish candle. So we take our long position here. The stop loss is gonna go right under the entry candle. The take profit is gonna be 2 times the risk, letting the trade run. And as you can see, it was a profitable trade. Now, keep in mind that we're only going to be looking to take trades whenever the price breaks and retests the current day's highs and lows. If it breaks above a high level of 1 day ago or 2 days ago, we will not use those levels to trade because per my testing, they don't have higher chances of producing profitable trades. Now, here is an example of a short position. It was a beautiful day and you woke up and saw that the price is in a bearish trend, indicated by these 4 EMAs lining up like this, which tells you that you're probably going to be looking to take short positions. You mark your current day's high and low prices. This dotted horizontal line indicates the high. To extend it to the right, I'm going to put a horizontal line right here, and for the low price, it's going to be indicated by this dotted horizontal line at the bottom. I'm gonna put another horizontal line right here to extend it to the right. We wait for the price to break and close under the low, and once that happens, we will be looking to take short positions. Now, unfortunately, this did not break under the low, so we're gonna have to wait until the next day. But that is still okay. We wait for the price to do a retest of this level, and right here, we can see that this dodgy candle touched the horizontal level with a wick, which indicates a retest. Now, it's a red candle, which means we probably should enter our trade right here, just like we did with a long position. But the problem is, this is a dodgy or an indecision candle, which is usually risky to take trades with. So I'm gonna hope that the next candle after this is gonna be an engulfing candle, or a strong enough candle to have me consider taking this position. And as you can see, this is a pretty decent red candle, which means it's time to take a short position. The stop loss is gonna go right above the retest candle, which is this one. And for the take profit, I'm gonna set it at 2 times the risk, letting the trade run, and as you can see, it was a profitable trade. Now, here is another short position. As you can see, the trend of the market is bearish, which means we're going to be looking to take short positions as soon as the price breaks and closes under the current day's low. This is the low of the current day, and the price broke and closed under it right here. This candle came back and touched it with the wick to indicate a retest, but since it's a green candle or a bullish candle, we can't use it to enter our position. Instead, we're going to be waiting for a red candle to be printed before we enter. This red candle indicates that the price is more likely to continue going downwards after this retest, which means we're going to take our short position right here. And as you can see, it was profitable. Ladies and gentlemen, this strategy was made possible by the previous highs and lows indicator by Lux Algo. Go ahead and check it out on TradingView, and if you're interested in using it along your strategy, feel free to do so. And if you find a way to use it, be sure to let us know in the comment section below. That's been it for this video. I really hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.